Money and HFT goes on-chain. If you only watch one crypto update today, make it this one, because miners are merging and mooning. Atop dYdX wants your trades inside Telegram, venture dollars just bet big on programmable money, and high-frequency trading is coming on-chain. Wait till you hear how these threads connect, and stick around for my bold takeaway on who's likely to benefit first and the one pitfall to avoid this month. Let's start with the loud headline. Gryphon Digital Mining is set to merge with American Bitcoin in September, and Gryphon stock has already gone beast mode, up more than 200% since the deal was announced in May. The plan is an all-stock merger. The new entity keeps the American Bitcoin name. And here's the twist. Founders Eric Trump and Donald Trump Jr., together with Hut8, are expected to own the vast majority once it lists. Anchor investors reportedly include the Winklevoss twins. Why investors care? This isn't just another minor headline. It's a signal. You're seeing three forces converge: public listings coming back into fashion for crypto companies, miners consolidating to scale, and treasury strategies that treat Bitcoin like a balance sheet asset. That's the MicroStrategy play, but with hash power attached. What to watch? Post-merger dilution math, energy and fleet efficiency, and how aggressively the new code grows its BTC treasury, because miner equities tend to outperform BTC in bull legs and underperform in drawdowns. Survival tip: if you play the equity side, don't marry the ticker. Use the technicals like you would on BTC. And remember, miner beta cuts both ways, as reported by Cointelegraph. Now, the one that'll either make you clap or cringe. dYdX wants to bring trading to Telegram. Yes, your group chat might double as a trading terminal. dYdX updated its roadmap with a September target for a Telegram-based trading experience powered by its acquisition of a social trading app. They're also rolling out partner fee shares up to 50% to reward volume contributors, TWAP and scale orders for better execution, and designated proposers to lower latency at the protocol layer. Why this matters? Decentralized venues are finally going after the one thing CEXs guard like Dragon Gold: slick UX. Lower friction plus better execution tools are how you claw market share back from centralized exchanges. The catch? dYdX's earnings have slid year over year, and TVL is down from peak. So this isn't victory laps. It's offense because defense isn't working. What to watch? Does Telegram trading actually lift active users and volumes, or does it end up as a fun demo with security trade-offs? If they nail off phishing education and latency, this could be a wedge feature. Survival tip: if you try it, sandbox first. Small size, fresh wallets, and never authorize what you don't understand. Social UX can be a fisher's playground, as reported by Cointelegraph. Next up, programmable money is having a moment, and it's not just buzzwords. Nearly $100 million just flowed into two stablecoin infrastructure startups. M0 raised $40 million to let developers issue app-specific stablecoins with rules baked in. Think game dollars or app cash that can only move where the code says. And Rain raised $58 million to build bank-grade rails for issuing regulated stablecoins and running real-time compliant payrolls across 100-plus jurisdictions. Same-day flex, stablecoin market cap hit a record high. Why this matters? Programmable money is how you move from simple transfers to policy-grade, audit-friendly, conditional payments. For investors, that unlocks sticky use cases: payroll, cards, vendor payments, trade settlement, while shifting value from token go up to who controls the rails and fees. Watch list: who wins bank partnerships, how fast they expand beyond a single chain. Rain is already on Solana, Tron, and Stellar, and how these rails plug into consumer apps like gaming or wallets. Survival tip: if you're evaluating tokens in this niche, read the docs like a CFO. Who captures the yield? Who sets the rules? And where do fees accrue? In a token or private cap table, as reported by Cointelegraph. And then the nerdiest headline with the biggest long-term punch: A Priori raised $20 million to bring institutional-grade high-frequency trading on-chain. Backers include big names from both crypto and traditional prop trading. Their pitch: fix wide spreads, reduce MEV leakage, and handle toxic order flow so market makers aren't constantly stepping on rakes. Translation: better plumbing for faster, fairer prices in DeFi. Why this matters? On-chain markets have the talent and the TVL, but they still bleed edge to MEV and latency. If the pipes get faster and fairer, you narrow spreads, deepen books, and entice serious liquidity. That's how DeFi grows past speculation into a credible 24/7 market stack. What to watch? Does A Priori actually improve execution outcomes on real venues? Do we see spreads compress on active pairs, or just nicer dashboards? And how do they mitigate MEV without adding central choke points? Survival tip: when infra-level C-level teams show up with prop trading DNA. Expect rapid iteration and occasional breakage. Don't size up just because the words institutional and on-chain are in the same sentence. Okay, big picture time, because these stories rhyme. On one side, you've got miners professionalizing, going public, and stacking BTC as treasury. On the other, dEXs are fighting CEXs with UX and execution toys you can actually feel, like trading inside Telegram. In the background, stablecoin rails are getting programmable brains, while high-frequency quant tech starts plugging directly into DeFi. Altogether, that's crypto maturing into real financial infrastructure, cleaner price discovery, richer payment logic, and better pipes. And you don't need to be a venture capitalist to benefit. You just need to align with the flow. Here's how I'd frame it for the weeks ahead. Survival first. If you play miner equities, treat them like leveraged BTC with fundamentals. Track fleet efficiency, energy costs, treasury policy, and dilution. Use levels, not loyalty. If you try dYdX's chat trading, security is the whole ballgame. Fresh wallets, multi-sig where possible, and never authorize what you don't understand. Social UX can be a fisher's playground. For programmable money, follow the contracts, not the banners. The winners will own bank partnerships, compliance throughput, and per-transaction fees, not just token logo mindshare. For high-frequency quant tech infra, the first real signal is spread compression where you trade. If you can measure better fills on the same pairs and time windows, that's your green light to lean in. Slowly. Here's the spicy hook I promised. If dYdX actually nails Telegram trading and a priori style infra narrow spreads where you live, the next incremental winner isn't just DeFi tokens, it's the volume and the fee engines that capture it. Meanwhile, programmable stablecoin rails will quietly eat the payments vertical from the inside out. My pitfall to avoid this month is chasing headlines without a level. If you can't point to a clean support or a clear invalidation, you're not trading, you're hoping. If this breakdown helped you see the chessboard, do me a solid. Smash that like so more people get the survival playbook. Drop a comment with the story you think matters most. Gryphon's merger, dYdX's chat trading, Programmable Money's breakout, or HFT going on chain, and tell me the exact level you're watching next. And if you want crypto news with less hype and more edge, hit subscribe and ring the bell. Trade the plan, not the headline. Educational only, not financial advice.